Morning everybody. Today we're going to be learning about market failure in financial markets. This is part of theme 4 and you've just learnt previously about the different types of institutions that we have within financial markets, like banks, central banks, commercial banks, retail banks, and also insurance companies and pension funds, and there are other different institutions that you can have. This is looking at how these financial markets can actually fail. There are four main areas where we can have market failure. That might be a way of remembering. There are 4 of them. These are things that in some cases you'll be familiar with already because we've looked at them in Unit 1 when we were looking at market failure. But now we're looking at this in the light of financial markets. So I'm going to go through all 4 of these. The first one is asymmetric information. Then we'll look at moral hazard, speculation and market bubbles. And then the last one is externalities. Asymmetric information. As you know, asymmetric information is where you don't have symmetry of information between 2 parties. So, for example, this might be between a consumer on one side and a bank on the other side. This is where perhaps the consumer has less information than the bank about a product that they're being sold, and this results in them buying something which isn't necessarily in their interest or doing something that isn't necessarily in their interests. An example of this was when in the US, and it happened in the UK and other countries in the world as well, banks started giving loans for buying houses, so mortgages, to those who may have been a high risk, essentially. These parties were being given mortgages to buy properties, and they might not have been receiving a regular income, so they wouldn't have been able to pay the mortgage every month. The bank that sold them this knew that, but actually the consumer wasn't aware of all of the implications of, for instance, if interest rates went up, why they wouldn't be able to keep up their payments and that this would pose a risk to them. This became even worse because these mortgages, the money that was due to the banks every month on these mortgages, that was packaged up and sold as a product to other banks. And this was called, you don't need to know about this, but specifically, but it was called securitization. And this is where the right to receive the money from the consumers every month on the mortgage by the bank, they were having all of this money coming in, they sold that right to receive the money to another bank. And then they sold it to another bank and another bank. And what happened here was that not all of the banks that were buying the product along the line understood that actually some of these consumers at the beginning who had taken out the mortgages were very high risk and might have defaulted on their payment of their mortgage. This meant that there was asymmetric information in this market, and ultimately it was the securitization of mortgages which was largely contributory to the financial crisis in 2008. Another example of asymmetric information would be the PPI, which was payment protection insurance, which was given to people who took out loans. They were given an insurance, sold an insurance by banks, and often the consumer didn't realise that they were being sold this insurance policy, and it wasn't necessarily to their benefit, but they were doing it without having full information, and it wasn't in their interests.